Now we're going to go into the U.S. and provide, a broad overview of some of the data that's come out. How have things changed a bit? What has changed, what hasn't. And so we're going to look at what the FOMC, what the market is expecting. It has changed pretty wildly. Now there's an expectation that the Fed will only hike twice in 2022 and not 3 times. It's moving around pretty aggressively depending on what Powell has said. He's gotten a bit more hawkish, which again is increased, where he's saying that they could end tapering, or they could end easing a few months early, which just means that they'll accelerate the tapering. So this is some of the volatility that has started to come into the market. And with the emergence of Omicron, the Fed rate hike expectations have been pushed out a bit. Market shifted to expect easier monetary policy more than before. Again, it's gonna waffle back and forth. What is happening with the data? What is happening with inflation? That I think is going to dictate. I still expect to see 3 hikes in 2022. But again, it's just going to come down to when is there an end in the tapering in general. That will dictate. But I think we will get at least 2 at this point in time. So now when we start looking at the U.S. data, and we're going to touch on some of the different pieces. So manufacturing was right in line with expectations. That's consistent with what we were saying in November. So again, nothing too surprising. On the services side, you can see that there was an expectation of 59. We came in at 57. That was something that we were expecting as well, where some of that slowdown on the consumer end really started to take hold, which limited some of the positives that we should have seen in services. So again, nothing too crazy in that on that front, which has brought the U.S. composite, below what it was last month to 56.5, which I think is something that we're continuing to see of that net slowdown, where manufacturing is still up there, still trying to feed the beast as the supply chain remains tight. People are still trying to pull in volumes, and that's keeping manufacturing well bid, while services continue to struggle under rising prices, and some of that shift in slowdowns in just demand. Now, when we start looking at the Richmond Fed, right in line with expectations, a little bit of a slowdown, not much to talk about there. Initial jobless claims came down to 199. They're back up, but up less than expectations. We'll talk about that in a minute. Wholesale inventories, the expectation was for 1%. It went to 2.2% in October. That has since fallen in November, so they're starting to come back down, and that's going to be something that we're going to want to talk about, as retail inventories were expected to be at 0.5. They came in at 0.1, and those have also come down. So again, you're seeing all of those inventories get sucked out of the system that will have to be addressed. And then when we look at personal consumption, things fairly in line with where things were going. The official GDP price index, worse than initially expected. It was expected at 5.7%, came in at 5.9%. Again, just showing how we had that big acceleration in inflation in Q3 that continued into November, but has since started to slow into December, which we think will continue into January and February. And now when we start looking at durable goods, durable good orders, again, looking forward, expected to be at 0.2, came in at negative 0.5. That has, again, seeing that stabilize a bit, not so much up or down, but starting to see that flat line as some of the underlyings have gotten a bit better. Again, but still stuff that's fairly in line with where we were looking. Personal income was expected at 0.2, came in at 0.5. That is something that has remained strong in November as well. Personal spending was expected at 1%, came in at 1.3%. That is something that we expect to come down, because remember, we thought October was going to be very strong, was going to be above estimates. Here we are. Now we think November is going to disappoint to the downside, and then you're going to see some of that bleed into or more decelerating into December. And then real personal spending, which was, I think, the best in this underlying backdrop, because you're factoring in inflation, expected at 0.5, came in at 0.7%. PC deflator, right in line with the expectations. Again, showing just where some of that stickiness is on the inflation side, especially on the sticky inflation. We did get a chemical company that just raised the price of primers and paints by 35%. And again, that's a huge number when you think about just how the implications of how that's going to hit everything from interior, exterior paints for homes, primers for cars. Again, all of that, because what doesn't get painted in this day and age, from everything from appliances and other, that's going to, again, increase those costs. University of Michigan sentiment expected at 66.9, came in at 67.4. Again, a nice little bounce up. Current conditions, fairly flat. Nothing too much to say there. New home sales fairly flat in compared to expectations, so not too much to say there. Then when we start looking at house prices, so here we start looking at, the S&P Core Logic was expected to see an increase of 1.2%, came in at 96 basis points. So a slight miss, but again, still seeing the positive acceleration. It's just the pace is starting to slow as we are starting to see some of that slowdown in home sales. Chicago PMI came in a bit light, expected at 67, came in at 61.8. Now, when we look at the consumer consumer confidence, that's where we got a little bit of a disconnect versus the University of Michigan, but the University of Michigan had a big drop already, and the consumer confidence hasn't. It's been moving down, trending lower, but the University of Michigan is kind of indicating where that consumer confidence is going to end up in, which is why we're not surprised to see it drop, and it missed by about 1 point. And then the same happened with present situation as the expectations also came down versus last month. ADP employment change was slight positive, expected at 525,000, came in at 534,000. We do expect to see jobs accelerate again in October. And then when we start looking at the market data, so market manufacturing PMI was expected at 59.1, came in at 58.3. Again, seeing that slowdown as some things start to normalize a bit, but we'll go through some of the specifics in the next few minutes. ISM Manufacturing was expected at 61.2, came in at 61.1. Again, manufacturing kind of holding in there, elevated, but we'll talk about why. Prices paid came down slightly, 85 from the expected at 85.5, came in at 82.4. Starting to see some of that, again, that slowdown, a little bit of that curve, starting to see the pace come down. That's the inflation that we've been talking about, some of those leading indicators that we keep looking at. New orders still accelerating, still strong. Employment, again, still coming in fairly elevated. So when we start breaking down the ISM manufacturing, let's look at the PMI. Here you look at the inventories, that nice inventory bump. These are the things that we've been talking about. Now, they have come down a bit in November. That'll continue in December. And again, that's going to have to get rebuilt. So that'll be a net positive. Supplier deliveries, if you take that out or at least contract it, that's where we should be if you think about it, just based on, again, it'll always be there. It's just not to this size, which is why we keep talking about this trend closer to 55. Then when you look at new orders, that accelerated a bit after the deceleration in October. Again, you saw some strong movements in October. That has to be refilled, hence the new orders in November. Some supplier delivery times have dropped slightly, which has helped pick up some of the backlog, which as the backlog shows up, you can then issue new orders, and some of those are important pieces. So when we start looking at prices paid specifically, we're not really coming down. It's just we're now finding this comfort spot, because prices paid, when you look at PPI, when you look at import prices and what's happening globally, you're not seeing this huge contraction. This is where you're starting to see this balance out. And then here is where, when you look at ISM order backlogs, that has started to come down, which is, again, is why we're starting to see those new orders pick back up a bit, and prices paid just holding in. And we just expect this to go a bit more sideways, curve down a bit more, maybe get a little bit more deceleration, which is that net positive for some of the leading indicators. But then when we start looking at inflation as an aggregate overall, altogether, the alternative inflation metrics, such as the Dallas Fed Trim Mean PCE and Cleveland Fed, the median trim PCs are following a broader CPI increase. And they're supposed to be less volatile, but highlight the broadening price pressures. So this is just showing, again, you had those leading pulls, you had those movements up, but this is just showing that the pace is still there. And even though you're going to start to see, again, like we said, prices paid, those leading indicators starting to balance out, there's companies that wait to see how real is inflation. Can they raise prices? Are they going to lose customers to raise prices? Because for some companies, it's very costly to change to change prices because you might lose customers. What are your competitors going to do? And this is just showing that now that we've had such an extended period of time of inflation, now they feel comfortable passing that through, and which has turned, again, Powell a bit more cautious and hawkish as these levels have moved. And this is when you start looking at the spread between flexible and sticky CPI, which has never been wider. So this is going back to the 1970s. And we're at 12.6%. And this is what we've been talking about. The sticky one is just starting to really ramp up. So while that flexible, which is when we're looking at prices paid, we're starting to see some of that mobility. As that levels off, that stickiness is going to come up right behind it, which is why Powell has changed course a bit. But with everything happening, inflows into equities exceeds combined inflows of the past 19 years. So this just gives you an idea of how much money has come into the market over this time frame, which to me is just utterly fascinating in terms of how everybody has really, have really just dove right in. Water's fine, and the question is now, what happens if we get a bigger slowdown? What happens when we start getting some of this tapering? Do people leave? If they leave, is it kind of this everyone screaming fire in a crowded room? And this is going to be one of those interesting things to watch going forward. Now, as people are faced with getting boosters, I think one of the interesting thing is, as I have 3 children of my own, will you vaccinate your children and against COVID? And 37% said yes, already have or plan to. But over 50% say no, I do not plan to. And I think this is the concern of what is the impact on children? Why are we doing this to children? What are when you look at the metrics of which, as I've been saying since 2020, I should say Feb and March of 2020, the things to look at is hospitals, infrastructure. How are things stressing in general? And this is, I think, showing that when you look at that data, how many children are in the hospital, how many have died from it. And again, one child is one child too many, but what are the implications? And that's where I think people are concerned and are getting some of this hesitancy. So this is going to be an interesting one to see how it develops. And the reason why we talk about that is because there's some sides that say, well, without children getting vaccinated, you'll see mutations. But again, it's a coronavirus. It's going to mutate on its own just based on the nature of the virus. And that's going to keep, I think, the market a bit more uncertain until we see, oh, well, Delta wasn't that bad. Omicron isn't that bad. And you're continuing to see it weaken itself because, again, it's just like any life form. It wants to survive. And if you kill off the host, you do not survive. So typically the more stringent one, the more deadly one will die off quicker. And the one that is more contagious, less deadly, that's the one that will propagate the most and then replace and become, again, the dominant strain. So until we get people confident or comfortable with that, you're going to keep seeing a lot of this volatility, which is not going to go well based on how we see 2022 playing out. So then when we start breaking down ISM, as people, again, trying to get back to some of this normalcy, you had manufacturing coming in expected at 61.1 versus the estimate of 61.2, so right in line. New orders rebounded, as we talked about. Prices paid eased from 85.7 to 82.4. Production is at a 7-month high. Again, some of that ease in supply chain and employment component rose because remember there was some different companies were either shutting down some assembly lines or cutting some production levels because they were, again, trying to manage the fact that they had shortfalls. If you have a shortfall, you can't, and if you don't have the finished product, the semi-finished product, the raw materials, you have nothing to assemble. You have nothing to build. So now that you're starting to see some of that come down a bit, you saw some of the backlog come down, some new orders pick back up. It meant that you could hire back some of these individuals. So then when we look at the contribution to the headline pieces, again, you see that inventory creeping back up. That's something that's going to come back down, but it's going to be a net positive overall as we progress into 2022. As supplier deliveries come down a bit, we expect new orders to creep back up, employment to stay right around this level, and production to kind of marry with what do we have in inventory. And as inventory comes back down, we would expect new orders to dip a bit. And that's, I think, going to be important going forward and indicative of the strength in the market. But this is just looking at retail sales to inventory, climbed to higher to new peaks in October, which is just showing that the stress is persisting. And this is where we continue to see these stress points. This is going back to the early 90s. We've never been in this level before. And this is why we continue to see a lot of these inventory being, again, some of that benefit as we go through into 2022 and offset some of those deflationary pressures, some of that slowdown in economic growth, because you're going to have companies kind of stepping in, and retail needs it as well. So again, retail is going to be stepping in as well, because who wants to buy goods at these prices? You're going to try to say, well, I obviously need to eat. I obviously need stuff. So I'm going to buy what I need, but I'm not going to stock up my basement. If I own a small business, I'm not going to stock up my storerooms. I'm just going to try to manage to make sure my shelves aren't empty, but I'm not carrying this huge cost, this huge fixed cost in my inventory levels. And even when you take out autos, so X autos, you're still seeing this elevated level. It's not at perfectly new levels, but you keep bumping along these stress points. So then when you look at the cumulative shortfalls in real private inventories, here you can see they're going to continue. And as we keep saying, they're not going to get much better, but they're going to try to manage it through 2022, which again is going to keep some of those levels fairly big going forward. Then when you look at personal income, when you don't have inflation, here you can see that things continue to trend up. But then when you take the real disposable personal income, again, factoring in inflation, we're now back below that trend and moving in the wrong direction. And until you get some additional benefit or reduced cost out of the supply chain, because that's where, instead of giving these wage increases, they're trying to, again, manage some wage increases, but you still have your supply chain costs. So as some of those supply chain costs come down, we expect some of that to go into wages, which again is going to keep prices fairly sticky where they are, which is why we are not seeing deflation so much, but really more of a stagflation as we go into the middle of next year. And then wages going up across the board. So low skill, mid skill, high skill, they're all trending up. The question is, obviously we've been talking about high skill, not as much, but you're seeing those wages moving in the right direction. The issue is, what is going to happen? So please select the extent to which your firm raised wages, and you're getting an idea of how many companies did raise wages. And it was pretty much most of them, and most of them raised at least 70 to 80% of them raised wages at least either less than 4% or 4% or more. It's just that is still not enough to keep up with inflation, because inflation, when you look at the year over year aggregate, is over 6%. So unless you're raising your wage 6%, you're not there. So again, you as a 4%, 5%, yes, but that's where you're not seeing it keep up with prices, which is why that stagflation will allow the wages to catch up a bit, start to stabilize. But that's where we're going to see some of those pressure points, because some of these individuals are seeing their daily living costs go up. And when even though wages will come up to meet it, you've already seen the additional, savings, disposable income come down. And we do have rents going up. We do have home prices starting, they're starting to flatline, but still elevated. And wages would still have a huge way to go to try to make up with where home prices are. And that's where you're going to continue to see some of these pressure points, even on the consumer. Now, when we start looking at input prices, so this is looking at market U.S. composite PMI input prices went to a new high. Now, input prices, it's just a mixture of where, and this is where those input prices continue to be elevated. And this is, again, keeping into that stagflation where the pace of these increases is going to slow and start to roll over and normalize right along this level. And then when you start looking at U.S. manufacturing and consumer prices still remain elevated in general, but this is where we see this kind of balancing out. Going back through 2004, they're still at elevated levels. They're still not going down, but that's, again, giving way a bit more into that stagflation. And then when we start looking at the U.S. manufacturing PMI, so here moved down to 58.3, still, so it's an 11-month low. Longer lead time, supplier shortages, higher energy prices pushed rate of cost inflation to fresh series highs, yet pace of increases slowed. And that's what we've been talking about. So one of the things that was said, while demand remains firm, November brought signs of new orders growth cooling to the lowest so far this year, linked to shortages limiting scope to boost sales and signs of pushbacks from customers as prices continued to rise sharply during the month. While average selling price inflation eased as firms sought to win customers, the rate of input cost inflation hit a new high, hitting at a squeeze on margins. Again, weakening a bit on the profitability side, on the corporate side, and you're starting to see pushback on pricing, and that's where we really do think November sales are, especially retail sales, November is going to slow, and that's going to continue into December. And then when we start looking at some confidence, so just another chart suggesting that margin pressure is building, as was indicated from the ISM data, from the IHS market data. So U.S. CEO confidence, so confidence is starting to come down. Small business optimism, minus the percent of firms planning wage increases. You're getting an idea of just where we sit in general and how when we hit these low points, you can see where in a recession normally sets in. So again, just looking at where that growth is and why we continue to see a Q2, Q3 issue really starting to pick back up, really starting to hit as we head into middle of next year. But when we start looking at small investors making a comeback, this is where people are trying to close out the year strong, figuring out where things are going, and we keep seeing some of this money coming through. And I just think it's funny because you're seeing people concerned about their situation, concerned about wages, concerned about inflation, but yet here we are actively hitting the stock market, or at this point just the casino. So then when we start looking at consumer confidence, again, looking at where is the consumer? So they're investing more, they're trying to invest more. And then when you look at confidence in general, future business is negative, present business is negative, future income is negative. So again, you're starting to see some of these pressure points come down, which is just dragging it lower as present employment starts to come down a bit, future employment. Consumer confidence labor differential still remains positive, which is why present employment, future employment remains elevated. But as that future income starts to get hit a bit and that future business starts to come down, that's again going to keep pulling that lower as we go through the end of the year. Then when we look at Chicago PMI, dropped to November Chicago PMI dropped to 61.8 versus the estimate of 67. Prices paid, new orders, employment, and deliveries all rose at a faster pace. Production rose at a slower pace. So that this is where we're getting a little bit of the flip. And this is just, again, looking at some of the regional data so far. And then this is just, again, showing on just a scale of where consumer confidence is versus some of the others, which is why we do think that there's going to be some additional slowdown into year end. And this is why, when you look at the consumer confidence again coming down, but expectations are at the lowest point that it's been at since COVID started. So essentially we're saying that when COVID first hit in the beginning of 2020, the expectations are just as bad as that point, which is where we think there's going to be some additional pressure going forward. And then this is just looking at the Philadelphia Fed Business Outlook Survey. So the Outlook Survey came in better. The index came in at 39 versus the estimate of 24. This is looking at November. New orders, prices paid, prices received, shipments, unfilled orders, delivery times, and average work week all up. Employment ticked down slightly, again, but still fairly flat. So this is where you're getting some of this mix, and that's why we like to look at different regions, because not all regions are the same. Some will get better, some will get worse, but this is why we see, again, some of that stagflation, because some places are seeing prices go up depending on where your consumers are, depending on where your suppliers are. You're going to see some of those adjustments. And then when we look at Philadelphia Fed manufacturing, prices paid back to the highs, prices received still hitting new highs, and that the prices paid, what you paid out to your suppliers, is back at an all-time high, and prices received, you can see that prices paid is at 80, prices received is at 60. You don't just pay more prices for your input cost and immediately pass down that cost. It takes time, and that's why we still see this inflationary push. It's just going to be a matter of where some of those percentages are, where some of these things start to balance out. Now, in the next segment, we're going to go more into the U.S. consumer and how holiday spending has really progressed so far this year.